I wonder if I can use Restream. I probably could use Restream. Okay, let's talk. We're gonna let some people get up in here before we get going. Welcome everybody. I hope you guys are going to find this beneficial. We are going to talk about options. I'm gonna see if I can get this on Facebook as well. So give me one moment. Am I streaming? Kind of not really. I mean, I'm on stream, but I'm not doing anything right now. Why? Okay, baby. Well, I mean, the stream is on, so it's on right now. So that's your heads up, baby. I love you, girl. I don't know, actually. Let me see. No, I can't see you left. I mean, if you get up and walk, I'll probably be able to see you. What's good, guys? So today we are going to be talking about trading options. I'm going to give it some time, let people get up in here, because normally we get going and people start traveling, they start coming up in here and they start asking questions. So I'm going to give everybody some time to get up in here, let the video know what's going on. And yeah, I'm just going to give some people some time. And I'm also going to pin the YouTube link so you guys can come over to the YouTube channel and follow your boy, because that's where all the educational videos are going to be. Okay, so if you guys want to ask me questions or anything of that nature, I just posted the YouTube link in there. It's just a better experience on YouTube. You guys can ask me questions and it's not like filtered or anything like that, and it's not blocked. So if you guys have any questions about what I'm doing, make sure you come over to the YouTube page and follow the live stream from YouTube as well. All right, so I appreciate it. So again, I'm just gonna give everybody a little bit of time to get up in here so we all can get this knowledge at the same time. All right, cool. Thank you guys for coming by.
Thank God more. I grew up with less. Just to the right, raps to the left. Arj in the middle, got C to the death. Batch full of dogs with the 16s vets.
All right, let's get started. Here we go. Again, if you guys can't ask me questions here, join the YouTube side, and it will allow you to ask questions. So the first thing we're going to talk about is what are options and how do they work. Okay, so I'm going to break down what options are, how they work, how are they priced, and how you can make money off of selling options. So basically what an option is exactly how it sounds. It's an option to allow you to buy or sell something. Okay, so there's two types of options. You have calls and then you have puts. And for the people who have seen me do these before, you guys know that I enjoy going into Photoshop. So I'm going to pull Photoshop up because I just feel like it's the best. It's just the best way to explain things. So give me some time while my computer pulls up Photoshop. Okay, thank you guys. Also, if you're on the YouTube channel and you're over here and you guys are enjoying what we're trying to do, please make sure you hit the subscribe button. Please make sure you hit the like button, because it's going to allow us to grow as a channel. And I have a lot of good information that I want to give to you guys for completely free. So if you guys could just hit the subscribe button for me, and yeah, it would be greatly appreciated. Okay, so let's open up Photoshop, and I'm going to try to go through Photoshop and pretty much use graphics to define how options work and how you can make money. Okay, so let's go ahead and zoom in here. And this will be a small Photoshop lesson as well. We're going to create a new layer here. We're going to paint it white. All right. So pretty much what an option is a contract between you and your broker for an underlying asset in the market. And pretty much an asset is just like a stock, right? So Tesla, Apple, Microsoft, anything that's available to have a contract for. So you have one contract, right? And think about it, and think about all this stuff as like real sheets of paper. So the way that the market used to work a long time ago was there were actual papers that you would have to fill out to buy and sell things. So a contract is literally exactly how it sounds, a contract. So I have options and puts, right? And so we always do it like this. We always make options red. We always make puts red because we expect them to go down. And we make options green, right? Because we we make calls green because we expect calls to go up, right? So this would be, so we expect calls to go up. So this would be your call, and this would be your put options, okay? Okay, so now that we understand calls go up and puts go down, let's talk through and walk through how we make money off of this stuff. So once you write a contract, you have three things in this contract that you need to be mindful of. You have a strike price. Then you have a date, so expiration date. So expiration date. And pretty much, I mean, that's pretty much all you have. And then you have pretty much your premium, right? So your cost. Okay, so your cost is your premium. And all of these things add up to pretty much be how much this is worth, okay? So let's do this. Oh man, I'm typing on the wrong thing. Hold up, guys, 1 second. One sec, guys, my fault. On the wrong layer. There we go. Okay. So these are 3 things that you need to worry about when you're buying a contract. Every contract is worth 100 shares, okay? So this is worth 100 shares. You have one contract, whether it's a call or a put. So pretty much when I sign up for my contract, I'm going to have a strike price, I'm going to have a date, and then a cost associated based off of these 2 things, okay? So let's go look at those really quick. So these are different contracts for the SPY, which is the ETF for the S&P 500, okay? If I open up the weeklies, which means that it expires, this is when it expires, July 24th, 2020. So we have our first here. So we have 2020, July 24th, right? That's our expiration date. Now, once you see when I open up these contracts or this expiration date, I have all these different prices here, right? And so you'll see that it's called strike, right? So your price is your strike price, or the price that you think the actual stock will go to. So based off of the strike price, will based off of what contract I want. So these are 24th July 20s, or the 24th of July 2020 weeklies, and I can come in here, find a strike price, and then pay for that particular contract. So you'll see that here's the bid, here's the ask. Contracts normally have really huge spreads, and it's just because they're really hard to gauge on your intrinsic and extrinsic value. So the strike price for 255 for 24th of July right now is selling for, the ask is 280. The bid on it right now is 272. So let's just say, let's do something that's actually reasonable. These are all in the money. This is why they're black. These are all out of the money right now. And so pretty much if we pull up the chart, I'll show you what I mean. So right now the SPY is at $303. So if you look at these contracts, $303 is in the money. That means if you buy this right now, you're in the money. It means that you've already hit your strike price. All these that are kind of like purplish, bluish are out of the money. Okay, so that means that it just means the strike price is higher than the actual current price of the stock. So now you can look at the bids and the ask, and this is how much you're gonna be paying per contract. So if I come over here and I try to buy this, you'll see buy, and then I can do a single. I can just buy, and then I'll just do one contract right now just to show you guys how much it costs, and then we'll break that down. So this is my sheet for buying this actual contract. You'll see I'll spend about $1,200.65, and the most I can make off of this is $28,000. So the most I can lose is $1,000. The most I can make is $28,000. So the way that we get this price is we just multiply our bid or ask or whatever we're trying to buy at. If you have a limit order, by 100. So just pretty much multiply that by 100. So we buy here. You'll see the price is $962. Multiply that by 100, $962. So what you're doing is taking that for the price. What you're doing is taking your order. So I'll just say your limit right here. So your limit price times 100, right? Times X. Oh, X is a really bad. It's a really bad one to use, right? Because we're using time. So let's just do it like this. The price of the number of contracts that you have. I'm sorry. number of contracts. So your number of contracts. And that's how you get how much you're going to pay, pretty much, okay? Any questions so far from anyone? And if you guys can't ask questions, I've been getting a lot of people that say they can't ask questions on Facebook. Make sure you come over to YouTube so you can ask the questions and I can answer them for you as fast as possible. It's really hard to answer messages in Messenger. So if you want to ask me questions about options, come over to YouTube, click on the link that's posted and ask your questions in the YouTube, okay? So everybody understands so far. We got one contract, it's 100 shares. We get our price by however much we're going to pay for the contract times 100, okay? And then what this becomes is your premium, all right? So the price is pretty much your premium. That's how much you pay to write this contract, okay? So that's why the most I can lose is $962 because that's how much I'm paying for the contract. And no matter what happens, that's all I can lose. I can't lose any more than $962 on this. But you'll see that my max profit is $28,000. If all goes well, that's how much I could possibly make. But the most I could lose right now on this one contract is $962. That's not bad for, the spread that you can actually make. Let me make sure I don't have any questions from anyone. Why is it multiplied by 100? Okay, excuse me, one sec. So the reason why we multiply contracts by 100 is because a contract is an agreement between you and your broker to buy 100 shares at whatever strike price that you set. Okay, so if I was to exercise this contract, so let's say I was to exercise this contract and say I want to actually purchase the shares that this contract promises. That pretty much means that I'm going to buy 100 shares as you see down here. So every contract is 100 shares promised. Okay, that's why we multiply by 100. If you write a contract, you're writing it for 100 shares at a time. So you take your ask bid price, and normally what I do is I go somewhere in between. So right here, the spread is not that bad. It's 948, 962. I'm fine paying the ask because it's really not that much higher than the bid. But normally if it's really high, which you won't find much on SPY because SPY normally has really good spreads. But sometimes you'll find something where the ask is $3 and the bid is $1, which is a $2 difference. You don't want to pay $3 when the bids are $1. So I'll split that and then whatever your limit order is. So like if I did, so if I came in here and I did, you see my price has a limit. I can say, oh, I want to pay 962. I want to pay 8, right? It's just no different than buying a stock. I would take that 1 times 8. This would be $800 because that's what I'm paying for the contract. That's my premium. Okay. All right. So now that we know what our premium is, this is how we calculate how much the premium is. Let's talk about how options go up and down. So let's talk about what makes them go up and then what makes them go down. Okay. So when you have, I'm going to have to do this all over again. So let's just do a whole new layer like this. And then let's paint this layer white. All right, there we go. And then let's do one more layer and put that layer on top. So we're going to break this down in between calls and puts. So from our previous, we know that calls, we expect the stock to go up. Puts, we expect the stock to go down. So what I'm going to do is split this in half like this. And I'm going to put puts on one side, calls on the other. Puts and then calls. And I'm going to tell you guys how people are making so much money off of contracts, okay? Let me make sure I don't have any questions. All right, bet. Remember, guys, if you have questions, ask in the chat, and I'll answer them as fast as possible, okay? All right, so calls up, puts down, right? This is what makes calls go up. Make calls and puts go up. So if a stock goes up, if your stock goes up, your distance, so time, and your strike price. So I'm gonna do it like this, and all this stuff is gonna make sense once I explain it, okay? Let's say we brought it at $300 and it went up to 310 and our strike is 320. All right, so let's explain calls first. Man, every time I talk, I feel like I need water. So a call, this is how people make money off of premium. So what we're doing is we're buying, what most people do is they buy and sell their premium. Okay. Now I'm going to show you why they do that. So we look at this chart. This is the wrong chart. Let's look at an actual contract. And guys, no question is a bad question. Please make sure. Leave the line up, please. When I'm done cooking, I'm coming to watch. It will be on it would be on my YouTube. So make sure that you come to the YouTube. 'Cause I'll have this whole video saved on YouTube. So this is the price, or the premium price of this contract that we just clicked on. So this contract is the S&P 500 for a 294 strike price for July 24th. Okay. You'll see how it goes up and down just like a stock does, right? It goes up and it goes down. It doesn't go up and down as fast, just because, I mean, it's a little bit harder to calculate, but it does go up and it goes down just like a stock would. So what happens is, this is the cost. This is the premium. So you'll see that on 6/10, so 3 days ago, this premium was only worth $3.08 per contract, meaning that you were only going to spend $380 per contract. And this is how people, it's crazy to think that, look at these charts, but this is how people become very rich off of options. If you guess right, you can make a lot of money, because within 2 days, this went up from $3 to $11.69. Now, what's crazy about this is the type of gains that most people want from penny stocks, right? But you're getting it on a way better valuation, because this is the SPY. So I've doubled my money. I've more than doubled, almost tripled my money. I've gone up almost 300% in less than 2 days, because what ends up happening is the SPY, and this is, I'm going to show you this so we can go back over the chart. The SPY ends up dropping, right? So we all know the market crashed, and the SPY went from 323 down to 303. So this would be, if you bought a put, right, we expect the market to go down. So when the market goes down, the premium for the put contracts go up. And that's how fast you can make money off of contracts. The good thing about this is, if you would have spent $380, we can actually do the calculator. So let's do the calculator real quick. If you would have had 2 contracts at 386, you would have spent how much? 380 times 2. 380 times 2, you would have spent $760. Okay. If you take those same 2 contracts and you multiply them by the current price, I'm sorry, hold up, 200 times so 2 contracts on the 10th puts would have made you $1,500 in 2 days. Imagine if you would have bought like 5 or 10 or 15 contracts, right? You would been well off in just a 2-day gain. And so the reason why that happens is because of the way that we calculate stock prices, our contract price. I'm sorry. It's the premium is the limit price times 100 times how many contracts you have. So since this premium went up because it's a put, then that's what people are selling. They're selling these premiums, right? So I know I just went around the world with that. I don't want to stop and make sure I answer any questions. I just went a really roundabout way of explaining that. So please ask me any questions. I don't see any coming in. All right, guys, if you can't ask questions, please come over to the YouTube. It's way better. Come over to the YouTube. You don't gotta subscribe or anything. I would love for you to subscribe, but come over to the YouTube because you can ask questions on YouTube. It's 21 of you guys in here right now on Facebook, and I know Facebook is not allowing you guys to comment or ask questions on Facebook. So just click on that link and come over to the YouTube. All right. So I want to make sure that everybody, I've been seeing people in the chat or in the group ask these questions, and I want to make sure that you guys are getting the answers that you need. Okay, so since this stock went down, the premium for the stock went up, and what people do is now you have this asset, and I'll show you a picture of what it looks like. This is what a premium looks like. Where is it at? It looks just like a stock, right? So this is what you would see. You would see something like this on your account. It will literally say your contract. So this is my contract here. How much my premium is. So you'll see right now my premium is $2.36. I paid way less than that, right, for this premium. So I'm already up 17% on like a $5 move off, or less than a $5 move, a couple cents moves. Versus if I would have just purchased the stock. So the first one is me purchasing the stock. I spent $8,000 on FAZ, which is a reverse financial index, and I got 1% out of it. And then I spent $3,000 on the contract, the calls that it goes up, and I made 17% off of it, and made way more money off of $3,000 than I did with $8,000. If I would have put that $8,000 in the contract instead, I would have been making way more money, right? But I did this just to show people how beneficial contracts are versus just like owning the stocks forever. Okay, cool. So now let's go back to the example, because I sometimes I like to ramble, so I apologize. So call we expect to go up, and this is our example. Let me actually go get a call for you guys. I don't know a call that's actually working though. I guess we could do FAZ. FAZ works. Anything that's inverse should work. If we do the June 26 and we do the let's do the out of the money, so let's do the 20s, and let's look at this chart. So I'll pull that chart up, and then I'll pull up this one. So this is a call, right? And let's do a FAZ here. Hopefully we can pull that chart up. Think of America. Come on, TD. So option trading is about still making money if the market crashes. No, so I don't want to say options are. Puts are the, I don't know if you know what shorting is, but puts are the equivalent of shorting, and calls are the equivalent of buying. Okay. I'm trying to find, and I'll walk you through an option really quick for both. But I'm trying to pull up a actual contract for you guys, so we can like walk through and see how it works. But it's only pulling up, for some reason it's not pulling up the actual contracts for me for this company. Let's do it. All right, let's do a different one then. I just can't think of anything that went up. I can't think of anything that went up. I think I got one. We can do Docu. Docu I think went up this week. So if we go try to find some in the monies, let's see if we can pull up these. Okay, yeah, Docu did well this weekend. I lied, it didn't do well. All right, so anyway, let's just talk. I can't, because the market crashed and I cannot find an example for you guys. But this is how it works. Adobe went up. Okay, bet Adobe went up. Let's look at Adobe. Thank you. All right, so yeah, Adobe would be a good example. So let's look at the Adobe contracts. I don't know if the contracts will have gone up, but we'll check. Oh, that works. We can do this one. All right, so let's look at Adobe on the 5-minute chart. We'll pull up the 5-minute chart down here, and I'll explain to you why Adobe went up and down, okay? So this is 610. This is 612. So we're gonna look pretty much. We're gonna look pretty much here. So this is our chart that we're looking at. Let's zoom out a little tiny bit. 610 is right here. So if you look at this chart, it's wild, right? Because it almost mimics this in a way. We'll see that Adobe goes up here. We see that the premium goes up. And then we see it peaks about on 611. And then we see this peak kind of here, 611 aftermarket. So the premium still kind of shot up. And this is the dope part about options, right? Even though Adobe was going down, people was still bullish on their earnings. So even though people were losing money here, the contracts were still making money. People that helped the contracts were still making money because people were still bullish on the company in general, and they were rightfully so because, you know, they killed their earnings. So contracts are going up, but the stock's going down because people are still, the intrinsic or the extrinsic value is still better off. So the contract goes up, Adobe's ends up going up still, and the premium, if you would have brought at 12, you could have sold at 19 and made a lot of money. So I say that to say this is what people are selling. You're selling your premium on the contracts. You buy your contract down here, you spend 100 times however many contracts times whatever the price is, and then you sell this. And so that's why we'll say our calls we expect to go up. So if we buy at 300, so let's say the stock is at 300, the stock goes up to 310, and our strike price is 320. What ends up happening is the further away you are from your strike date. So let's say our strike date is, let's just say our strike date is July 24th is normally what I've been playing this week. So if our strike date is 24th and we're still here in June, we're a month away, we're still pretty far away from July 24th, right? We're far away from having to exercise our option. So the premium that we paid is going to go up faster the further away you are from your strike date, because the likelihood of you hitting 320 and today is the 13th and the stock is already at 310 is way higher. So you have more extrinsic value and people are willing to bet that this will hit 320 and go way past. The closer you get, so if this is price on this side and this is time, this is how it pretty much goes. It normally looks like that for your premium. So the closer you are, so if this is your strike, so let's say your strike is right here, you'll see it start going like this, and then it kind of starts to level off. So the longer you hold your contract, the less likely your premium is going to go up. Okay. All right, let's delete that. And I'm going to try to give you guys another example to make a little bit more sense. So it looks like this. This is your strike. Okay, so we know that premiums get more expensive the further out you are from your price, or the further you out from your date, and the closer you are to your strike price. So if you have 320 strike prices and you're still a month or two out from your date, the more expensive your premium is going to be. So if you can get into a premium far away, and then the closer you start getting to that strike price, your premium is going to go up. And like, it's going to be insane how fast your premium goes up. And so I don't know if we can, I think Boeing is a good example. Okay. So right now, if I go look at Boeing, we can look at all the Boeing calls, right? So let's look at the Boeing calls for this particular, for June 26th, which I think is the next 2 weeks. So 2 weeks out, we're going to look at the calls for Boeing. Let me make sure I'm not missing anybody's questions. Okay, I'm not missing questions. Again, if you guys have questions, YouTube link. I'm just saying that because I see more people are coming in. Head over to YouTube. I'll answer your questions. I get questions way faster on YouTube, and I think Facebook blocks a lot of you guys from asking me questions for some reason. So let's look at the contracts for the call contracts for July 26th. Okay. I mean, June 26th. So June 26th, 65 calls are about $120 out of away. So they're very far away. They're worth 8 cents, mainly because you're probably not going to get, you're not going to get those. Wait, are these? No, these are puts. I'm sorry. These are puts. So let's do calls. I'm sorry. I don't want to confuse you guys. Let's do calls. All right. So these should be way more expensive. Yeah, these are way more expensive now. Let's look at some out of the monies. Remember, everything that's like highlighted is in the money, meaning that it's below our after price, and everything black is out of the money. So let's look at like the 300s. So the 320s on Boeing are worth 78 cents right now. Does that mean it's a bad contract? No, it just means that the likelihood of you hitting 300 in the next 2 weeks when Boeing is at 186 is very low, right? So it's 89 cents or 99 cents for the 310s. Boeing is, like I said, Boeing is at 180. So if you think that Boeing is going to double within the next 2 weeks, I mean, by all means, you can bet on it. The premium probably won't go up that much because the likelihood of you hitting that and someone wanting to buy that contract from you is very low. No one's going to want to buy a call option at $315 and if Boeing is selling at $185. And that's why this one is so cheap. The likelihood of you hitting that by next week is very low. But the likelihood of you hitting maybe 200 is very high, which is why this is at $12. Another one was at $1. This is literally 1,200% more higher than the $1 one, right? So you can take that logic, you can take that same logic and apply it to other contracts, which is what people do, and this is how they get rich. So if I know that a call contract that is $20 out of the money. So right now the money is 189, so 190 pretty much is in the money. If I can look at this and say, okay, 187 is in the money, it's selling at $17 a contract. 190 is $1 out of the money and it's selling at 16. 200 is about $10 out of the money and it sells at 12. So if I can find a contract and pay for that contract when it's cheap and have enough time, so time decay doesn't kill me. So this is time decay, right? Where you kind of top off the closer you get to your the end point. If I can buy a contract far enough out, I may be able to make 1,600%. Does that make sense to everyone? Yes, no, thumbs up, thumbs down, smiley faces in the chat, something. Give me something. Yeah. Okay. Cool. So that's how people do it. That's what I do as well, right? So I'll explain to you how you make 1,600% now. Okay. So now that we understand how calls work, we expect it to go up. The way that call premiums work are intrinsic and extrinsic value. Intrinsic being the difference between the current stock, your current strike, and the current price. So your strike minus the price minus your premium will give you your intrinsic, and then your extrinsic is everything else. But you can kind of see, you can kind of look at it here and kind of figure out. Like I know, no problem, Raymond, no problem, bro. Like I said in the group chat, like I want everyone to have this information. All I do is ask you guys to like and subscribe to the channel, because I have a lot more stuff that I want to give you guys. I have a lot more stuff. I have a financial planning and wellness sheet that I want to give out to everyone. And it's real dope. It's really, really dope. I'll show you guys that sheet. At the end of this, I'll show you how I use it to figure out how much I need to save, how much I can invest, all that. So let's go back. So we know that we can look at these prices and kind of guesstimate where we would be in the long run. So $20 in the money is $26. So that's 2,000%. That's 2,600%, 1,700%. And I can kind of look, okay, if I can at least get a contract that's close to being in the money, I can maybe make 1,600, 1,400, 1,300% in a month or 2 months. So I'm looking at the 2 weeks out. I'm looking at 2 weeks out and seeing what their contracts are worth. And then, so what I'm going to do now is go 3-4 months down the line and look at the contract 3-4 months down the line and try to predict what the market is going to do. Okay. So if we look at 3-4 months down the line, where are we at right now? So we're in June. We're going to go all the way to the September, October contracts. Okay. So what I'm going to do is, at first I have to have a plan in my head. I have to have a plan of what I think the market is going to do in my head. I do not think that coronavirus, this second wave or whatever, I don't think the market is going to stay down. And I'm just saying that for the sake of this particular, call. I don't think the market is going to be down. I think Boeing is going to go up. I think this is going to go up. I think this is going to go up. I'm going to go buy calls. But you have to buy calls when the market is going down, because they become cheaper, because everyone has a pessimistic viewpoint. And so you have to be the smarter trader to be like, listen, in 3 months, the market is not going to be here. So I can look at Thinkorswim and say, okay, it's pretty even. If you look at this, more people are buying calls in Boeing. More people bought calls in Boeing on the 12th than brought puts. It's 50-50. So people are really torn. They don't know whether it's going to go up. They don't know whether it's going to go down. I can do the same thing for the SPY. I come to the SPY and see, like, out of all the people on Thinkorswim or on TD Ameritrade, there are 6,000 puts purchased or traded on Friday. Meaning either people were exercising or selling on Friday. And then there were 3 million. I mean, I'm just saying 1,000. There are 3 million calls on Friday. So some people are expecting it to go up. And you can see, like, what are the deltas between, so what are the strike prices, like all that stuff. So this is information that you can use to figure out kind of what you think you should be doing. But anyway, let's go back to Boeing. Let's say I look at this Boeing chart and I'm like, man, Thinkorswim looks complicated. I have a lot of charting on my Thinkorswim, so I apologize if it looks complicated, but it helps me. It really helps me find, it really helps me trade. So like if you see these down arrows, it helps me know if we're like in a down channel or not on all my day trades. So let's look at the chart really quick. Let's go back to 3 years. All right, Boeing was as high as 446. It started to drop a little bit. And it was averaging around 395, 3 whatever. And then it got to 356 or 355, 356. And then it just dropped all the way down. In March, it hit 89. And now it looks like we got this really big candle here for a week. We just dipped for a whole week. And I need to make a decision. Do I think Boeing is going to stay down? Do I think it's going to go down lower than 89? Do I think it's going to come back down to 113, 112? And then if I do, how long do I think it's going to take for it to get there? Because all this stuff goes into our strike price, our call, right? We got to figure out the time. We got to figure out the price. And then we got to figure out how much we should pay for that. So that's why I started with telling you guys how options work, so you guys can figure out all that stuff that goes into actually buying them, right? So I'm looking at Boeing right now and I'm like, man, you know what? The lowest it was at is 89. It's $100 above that, but it had this consolidation phase right here at 129, 159, which is about $30 out of the money, right? Meaning that the price is 89 right now, and this level that it was at for like months is about $30 out of the money, and it kind of was already almost there, right, at 164. So I'm looking at myself as a trader and be like, man, how long do I think it will take for Boeing to get down here? And do I think it's going to go down, or do I think it's going to go up? Do I think it's going to go up next week, or do I think it's going to go down? No, it's no different than any other thing that we do or that we trade, right? We're trying to make the best guess. I think Boeing is going to go back up eventually, but in the short term, it's going to go down because this is a really big red candle. This is 430 million on a red candle. That's a lot. It's bigger than any other candle that we've had since coronavirus started. There's never been that much volume on a red candle. So I am looking at this like it's going down. I'm going to buy puts. But in the long term, do I want puts or do I want calls? So I know that I want calls down here at 135, but I want puts all the way until 135. So I'm going to go find puts or calls that are so far out of the money that I can profit off of. I hope I didn't lose anybody there. Anyway, let's talk about calls. If I think Boeing is going to go down and I know where I want to buy calls at, I'm going to wait for it to get down there, or at least buy calls on the way down. And you can buy an average down just like you can buy an average down with stocks. So I can go to Boeing and I can say, I don't think that we'll come out of this in the next month or next 2 months, but I do think by maybe October, winter time, Boeing will start seeing a turnaround. So maybe I think by like November or December, I think we'll see a turnaround. So what I'm going to do is I'm going to go to the December calls. And right now, the December calls are December 18th. I can go to November and I can go to October, right? And I can look and see how much their calls are worth. And I say, okay, you know, based off of this chart I'm looking at, Boeing kind of capped off here at 235. I think it would be safe just to say Boeing gets back up at least to 220 if it drops down to this 235. So while everyone else is selling, I gotta be the guy that says, you know what, I think it's gonna go back up. So I'm gonna come in here and I'm gonna look at the Boeing. I'm gonna look at the Boeing 200 calls, right? And okay, right now the bid on them are $30, and the reason why they're $30 is because we're extremely close to it, right? So it's still at 89. But if Boeing dips, these calls that are now $33 are going to be worth what? How do we figure that out? We figure it out by this. We take our calculator and we say the current price minus the strike price is how far off. So if our strike price is 200, we minus it by 189.51. It's $10 out of the money. I go look at calls that are $10 out of the money now, which are, let's go back to June. 2 weeks. We'll look at anything that's $10 out of money. So anything that's 187 or 179, because that's $10 out of money. And they're going for $20. They're going for $20, $22 a share. So all I got to do is wait for that contract that I want to buy to dip when Boeing dips. And then I buy it, and then I know that it's going to go back up probably to $22 a share. And that's how premiums work. It's that simple. It's literally find the contracts, buy them at the right time, have a good time decay on them so you have more likelihood to buy it. Buy during the market going down, buy the opposite of the market if you think it's going to go back up. Put some good time decay and you're going to make mad money. Right now I have SPY calls. I have SPY 30 calls for October, right? I paid $690 for them, and I bought it when it was down at $299, and they were 69 cents a call, and I paid $690, and I have them, and so if they go back up, I know I'm gonna make it. I have the potential to make like $12,000 off of them if it goes back up like to where it's supposed to be. Thinkorswim looks yeah, I think I already saw that one. Thinkorswim looks complicated. Okay. Anybody lost? Do I need to break down anything else before we go into puts? And I think what I'm going to do is actually do some live. I'm going to actually start purchasing contracts for you guys. I wish there was a simulator that I can run for you, but I can't run it without the market on. Lost but keep going. Raymond, where are you lost at? Let's talk. Let's have some dialogue. Because somebody else is probably lost too, and they can probably benefit off of your question. Can you use on demand? I came in late, unfortunately. Portia, what do you mean by on demand? I'm sorry, I don't know what that means. Repeat the last part. Okay, I'll repeat the last part. Lonnie wants me to repeat the last part, guys. So I'm gonna go back over the last part. So we know that TD Ameritrade has a feature where you can replay the market. I've never done that. I've never actually thought about doing that. Wait, I'm gonna have to figure that out, because that actually would be dope if I can do that, because normally I just do it in my head. Is that like in a setting or something? It's crazy because I don't use TD Ameritrade to actually trade. I use Fidelity. I use TD Ameritrade to chart. Okay, so Portia, while you're telling me about on demand, I'm going to go back over the last part, explain on how I figure out which calls I want to buy or which puts I want to buy. So this is how it works, guys. When people are buying and selling contracts, they're more than likely buying and selling premiums, not the actual contracts. Because for the most part, if I had a contract that was in the money, I wouldn't sell it. I would exercise it. Excuse me. So what most people are doing is buying and selling the actual premium. Can I also chart like this on Charles Schwab? You surely can. TD Ameritrade just works better for me. I just like the interface better. I like how analytical and developer friendly it is. So I can write code, and I'm a software developer. So being able to write code to do what I want it to do, it helps for me. That's why I went with TD. So back to the question was the last part. So I forgot where I was. Oh yeah. So more than likely people buy and sell premiums, which is why a lot of people get so confused, I would say, with buying and selling options. You're not selling the actual option because no one is actually exercising them. We're selling premiums. Premiums go up, or they're calculated by a few things. One, the underlying asset. Is the underlying asset like the S&P 500, the Tesla, Apple's, Nike? Is that going up or going down? It's also calculated by your strike price and then how far you are out from your contract actually expiring. So your date, your strike price, and then the underlying asset is what calculates your premium. So it's pretty much the combination of your intrinsic and extrinsic value. Okay, so those three things go into your premium. If a stock price goes up or it goes closer to your strike price, your premium goes up on your call. If it goes further away from your strike price, then your premium goes down on your call. If the stock is close to your strike price by or far away from your contract expiration date, it shoots up way more than it would if it was closer. Okay, so all of these different variables go into how much money you're going to make off of your premium, right? So again, I'll pull up the picture one more time. This is a FAZ contract. It was a call that I wrote, and if I pull up FAZ, it was a contract that I wrote right here. I wrote it at $17 and pretty much 70 something cents. No, I think I wrote it like, yeah, 17.84. Right when the market opened, I wrote this contract. So if I pull this up and we look at it side by side, if we look at this side by side, this is a contract for FAZ, right? For July 10th. For a call or a strike price of $19. So I was $2 out of the money, or $1.50 out of the money, which is about 10% out of the money when I wrote this call. Okay. So I believe that I paid $1.65 for this particular contract. Right. So I paid $1.69 or 65 cents when I wrote this contract. I wrote at 17. Because it literally went all the way up to 19 to my call strike price in one day. I still had like a month before the contract expired. So because I'm so far away from the expiration date, this contract becomes more valuable because the likelihood of this going past 19 up to 20 up to 23 becomes more likely. So people want to buy it it becomes more valuable, right? So that's how we calculate how much our premium is going to be: time, strike, and the underlying asset. So what we were doing and what I was explaining was, how do I know what contracts to buy versus what contracts not to buy? How do I know how far out I want to be versus how much in the money or how much out of the money I want to be? And you can do that by looking at current contracts. Okay. So we're pretty much going over the last part of how I figure out how to buy calls for long term. This is all long term. This is not, I don't really try to day trade this too much, because I mean, day trading is too stressful for me, and I just don't have the heart for it. I like to make smart plays that can make me $5,000 or $6,000 down the line. Okay. So what we're gonna do is look at about a month to 2 weeks out and see what those contracts are selling for. That's my sweet spot, a month to 2 weeks out. And we're gonna go to the current chart or whatever underlying asset we have. We use a SPY for this one. And so we're going to look at about $20 up, $20 down on this, just because that's almost 10%. We can do 30 and 30 and do 10%, but 20 is really good for me. So the SPY is going at $303 share. We're going to go 20 up, 20 down. So 323 and then down to, oh, my back, and then down to like 178. Okay. So we're going to type in SPY. I'm going to look at this current week, or the next 2 weeks. So I'm going to look 2 weeks out. These are all the weeklies for the SPY. Colorful means in the money. Black means out of the money, right? So if you look at the strike price, 289 is lower than 303. So that's in the money. So what I'm going to do is look at the 270 contracts, because they're in the money. They're selling for $30. Okay. So I'm saying this contract right now for this company is worth $30 when it's about $20 in the money. That's the premium, right? More than likely, that's the premium normally for this. $20 in the money is normally probably around $30 2 weeks out. That's just how you calculate it, right? So I can say, okay, this one is $20 in the money. It's worth $30. What does $20 out of the money look like? Okay, $20 out of the money looks like $1 and some change, right? We're not really happy about that. $20 out of the money 2 weeks out is 68 cents. But if we look at $20 a month out, let's look at $20 a month out. If we go to the July, we go $20 a month out, and this is why I tell you my month is my sweet spot. Look how more expensive they are here. They're 170. They've almost doubled a month out because it's more time, right? So when we did $20 2 weeks out, it was worth a couple cents. We did $20 a month out, it was worth $1.78. So that's why a month to 2 weeks is my sweet spot for exercising or selling my contracts. So now that I know that I have a range from $30 2 weeks out in the money, $20 up, and about $1 or some change, $20 out of the money a month out, I can then go buy my contracts. Okay, so let's write that down. So $20 in the money was worth $30 a contract, right? $20 out of the money. So 2 weeks out was worth 86 cents. So that's 2 weeks. And then we'll do a month. So $20 a month out, and I'm just gonna be, that's probably gonna be crazy money. If we look at July, what's it, the 10th? Yeah, we'll do 10th. We'll do $20 in the money. We'll do the 73s. That was 30, 31, 35, 31. So these are going for 31, and then these were going for $1.76. So this is a month out. Okay. So now I know I have these prices in my head. I say, okay, the contracts go for 30. If I can get within $20 and I'm a month out, I can sell for 30. If I can get within $20, if I get $20 in the money, I can sell for 30. If I can get at least $20 out of the money, meaning that it's $20 to go, a month out, I can get $1.76. Okay, cool. I can deal with that. So that means I need to find out what's the likelihood of being in the money and what's the likelihood of being out of the money with by $20. So then I go back to my chart. I say, all right, well, you know, it's never been higher than 323. Or hold on, let's go a little further out. It's never been higher than 339. So do I think that the S&P is gonna bounce back over 339? Probably not. So is right now the time to buy? Probably not, because it looks like we're gonna dip a little bit. So maybe I should wait a little bit more. So all this stuff is going in my head because we have time decay. When is the right time to buy? When is not the right time to buy? Should I average down? Stuff of that nature, right? I normally say just go ahead and average down because you can't nail your trades. Average down means you keep buying the same call over and over and over again until you come to a really good average, right? So I'm gonna go good time decay. It took us how many months to get out of this? 1, 2, 3 months. It took us 3 months to kind of get out of this. So I'm gonna do a 3-month call. I'm gonna go to the SPY and I'm gonna try to go 3 months out. And if I can go further out than that, maybe I will, but I think by October, September, we'll be fine. So I go back to October and I look at their calls. Right now, all these calls are in the money, right? So they're mad expensive. This is $100, $42, $78, right? They're mad expensive. I'm gonna try to go find a cheap one and see how much it costs. Okay. Here goes one, 364 for 88 cents. Right now, that's about $30 higher than the high. Do I think we're gonna go back to highs? Probably not. So I won't buy that one, right? That's probably not a good one. Here goes one for 360. That's $1. Actually, I needed to be doing all calls because there's some puts in here. Okay, cool. So maybe I'll go for the 340s, right? 340s means that 320 I'm in the money, 360, 340 I'm in the money, and I go 360 and I can go 360 up, 322 down, and I think that's a really good I think that's a really good place to buy at. They may go down a little bit more. So let's say I buy this one right now. It's $2.30 and it drops down to 68 cents later. Then I'll just buy it again. Now I'll just buy it again and buy it again as much as it goes down, and I'll start making I'll start averaging my position down. Right now I don't think it's the time to buy calls, to be completely honest with you. I don't think it's time to buy calls on the SPY. I think if it gets down here, this contract will dip down even more into the 140s, 117s. So I'm not buying calls yet because I'm trying to see what happens. But that's just how it works. You look at what's in the money now, how much it costs, and you look at your contract and figure out how much it would be in the money or out of the money at the time, in like 2 or 3 months out. 2 weeks to a month out, and then you sell it. All right, so I know somebody is stressed right now because I'm stressed. So questions, let's knock out some questions while I get some lemonade.
They call me Megatron. Shorty's a megacon. It ain't about the race either, it's the marathon. I put the squeeze on him, blow up the bees on him. That clapping on the D, Hercules on him. My name is Batty Batty. I keep it tight for Zaddy. He keep it coming. He ain't even dropped the Addy. Trunk in the front. I need a blunt. I own my own Moscato. We getting drunk. Fill up, baby, fill on me. Pull up if it feeling lonely. Fill up, baby, fill on me. Pull up if it feeling lonely. Shots, I'm drinking. It's better when I'm drinking. I tune up when I'm drinking. Rum when I'm shots, I'm drinking. It's better when I'm drinking. I tune up when I'm drinking. Rum when I'm
I love this chair. All right, I'm back. I'm gonna do a way better job explaining now because I got some liquor. So let's knock this out. All right, so we got some questions. Buy to close, sell to open. Oh man, that's a really good one. I think I'm going to try this on my paper account next week. Yes, Kimberly, that is a really good way to start. So let's do some option trading. Let me log out and let me log out and then let me do some paper trading. If I knew how to do the on demand thing, I would do it. So let me black out my screen really quick so you guys can't see my stuff. And I'm going to pull Thinkorswim back up and we'll do some paper trading on the other side of my account, okay? And I'm just gonna answer questions while I pull back up my stuff. Buy to close, sell to open. Okay, so there's one thing I didn't talk about, which information that you guys may need. Okay, what's good, bro? Boss back, man. Boss, you be supporting, bro. I love you, man. You really be supporting, bro. Boss came along with me on my my trading journey. So we're gonna do two things. I'm gonna walk you guys through what the different levels of trading are. So I think there's 5 different levels, okay? And so who asked the question? Mr. Logan, this is gonna be for you, okay? So you're asking me about buy to close versus sell to open, right? And it depends on what you're doing, okay? So 1 second. There's 4 levels. I thought there was 5. There's 4 levels of option trading, and they all allow you to do different things, okay? Level 1 is called covered calls and cash secured puts. So covered calls pretty much means that you already own the underlying option or the underlying asset, okay? So if I already own, let's say I own 100 shares of Apple and I own them, and Apple right now is at 350, but I expect Apple to go down to 300, but I don't want to lose my opportunity to sell at 350 if it goes down to 100 or 300, right? I can write a put that allows me to sell, or covered call to allow me to buy or at least sell my Apple at 350 even though it drops down to 300, okay? And it's only because on level 1 is because I already own that asset, and I'm doing a buy to close, if that makes sense. So I'm going to do a buy to close out an option, right? That's level 1. Level 1 doesn't allow you to write or sell premiums. It just allows you to write contracts for options that you already kind of have already. I know that sounds very strange, but think about level 1 trading as the safest option trading you can do because you already own the security and you're pretty much just covering or hedging your bets. Like you're saying Apple's at 350, I want to write a contract at 350 just in case Apple drops to 300. I still want to be able to sell at 350. So I'm still going to sell my assets, the ones that I actually own. I'm writing a contract and paying the premium to be able to sell at a higher price if it drops. Okay, so you're covering yourself. And I'll post this link in the chat for you guys if you want to go through and read about it if I'm not giving you a thorough enough answer or you need more explanation. Okay, level 2 are let's see, while there are no counterparts to risk to the broker involved in buying options, there's a risk that the option could expire worthless, which means you be lost, broker limits, blah blah blah. I don't know what level 2 really buys you. Oh yeah. Okay. Sorry, bourbon. So level 2. So level I'm showing you guys my wedding stuff. Level 1 gives you the option to cover calls and cash secured puts. So you pretty much can cover your behind if your options or if your assets are decaying. Level 2 allows you to buy and sell contracts. Okay. Pretty much what that means, if I'm writing a contract, let's say I write a contract for Apple and the strike price is 300 and Apple is at 350, and you want to come buy my contract from me because you're going to make a lot of money off of it, then you have the ability to purchase my contract. So right now, without level 2, you can't buy contracts from anyone. You're not in the option world at all. You're just in pretty much the stocks and bonds. With level 2 access, you can actually go buy contracts from people before they become like in the money. Like if you think it's going to be in the money and you want to come buy it from me, so you can exercise your right once it becomes in the money and make money. So let's say I have one contract of Apple at 300, meaning it's a $30,000 contract, and in order to be in the money, Apple needs to be at least 330. But right now, Apple's at 320 or 325, and you think it's going to go past 330, meaning that you're going to make money after you pay the premium. You can buy the contract from me at you're going to pay my premium, right? So we're going to exchange. I give you the contract, and then once the contract becomes in the money, you then can exercise the right to buy the contract. But see, the issue is, if it doesn't become in the money, you're going to lose a lot of money. That's why option 2, it says, is while there's no risk to the broker, like the broker doesn't have any risk at all, they just need to let you know that it could expire worthless, because 90% of options expire worthless, which could mean a complete loss at the owner of the option, meaning that I sold the option to you. You don't make any money off the premium. The premium is not like you may lose a lot of money. So level 2 just gives you the option to buy options. Level 3 is what I have, and or do I have level 4? I think I have. No, level 3 is what I have, and this allows you to write and sell options. So I can write options and make money off of premiums, calls, and puts. Now, your question about buy to close and sell to open is going to depend on what your trade is. Are you doing covered calls? Or are you doing or are you selling premiums? So I can go to, let's say BA. And I know, like, bro, trust me, I understand, because for the longest I had options enabled on my account, and I did not understand buy to close or sell to open. I couldn't understand it at all, and I gave up on options. But pretty much what I'm saying is, you have level 1, right? So I say all that to explain everything, like give you full circle, but you have a level 1 option account. You need to go and request level 3 if you want to buy and sell premiums, because level 1 is not going to give you the access to do what we've been talking about. Okay. So basically, and you can also do that with contracts as well, where you can buy and sell where you're like selling premiums, but that's a whole nother conversation. So I can it's a whole nother conversation. You gotta have level 4 for that. Okay. Does that explain what you need to do, bro? So basically, long story short, buy to close means you're buying a contract to close a position, and sell to open means you're selling something to open up a position. So yeah, it sounds weird, but buy to close is pretty much what most people are going to use. You have a position that you own, and you want to buy a contract to close out that position at the time in which it expires. Okay. The other thing is sell to open means that pretty much the opposite of buy to close. Like, you're selling to open up a position. It sounds weird, but that's just how it is, bro. All right, so puts. So puts are the opposite. We expect them to go down, right? You do the same exact thing that we did for calls, but you do it the opposite way. The cool thing about puts are so much cheaper than calls. Why? Because as investors, we have to know the market goes up more than it goes down, right? So when we're buying puts are just cheaper because people don't expect the market to go down, meaning that puts that are way out of the money can be worth cents. So if you have good time decay and you're way out of the money, then puts can be worth cents, literally like 3 to 4 cents. You can trade them. You can trade these big companies like penny stocks. It's insanity when I figured it out, and I just did not know that you could do it, but you can. So if I buy a put of the SPY, right, S&P 500, I can go all the way down to November and find some puts. So let's do filters. Let's do puts. All expiration dates, blah blah blah. Singles. All right. Let's look at. No, I don't want to look at December. Let's look at. I think the ones I got were August. I know these are not it. Hold on, it's a question. Is there a certain criteria you need to meet to move to the next level? You just need to lie if you don't meet the criteria. I hate to say that on stream. Nobody clip it, but you pretty much need to lie. They're gonna ask you certain questions like how much do you make, how much do you have as far as like liquid assets, how much how much do you make, what is your net income, how much do you have in liquid assets, how much risk can you tolerate. If you can't tolerate a lot of risk, you're gonna stay at level 1 because that's the least risky way to have options. If you can tolerate a lot of risk, and this is just a personal question, then they're gonna put you at level 3 or 4. You need to be at least level 3 to buy and sell premiums, okay? And I think Fidelity even has like a sliding scale that will show you what level you get based off of your answers. And I want to open up Active Trader because this is not giving me what I want. I'm not getting all of the, because I only have 4 strike prices. Why does it? Oh, I came to a different account. Okay, so these are puts, right? These are puts for the S&P 500 or the SPY, and we can see from the chart that I have it jacked up, and we can see that right now this, like, again, the SPY is at 304. It got down to 218. Blah blah blah. Right? We have a really good level here at 298, which is what it actually bounced off of. So if you look at this level here at 298, it bounced off 298 really strong, comes all the way back at 204. I got puts down here at 298. I'll probably continue to get puts, like we have another support level at 292. We have another support level probably down here at 279. You'll see that it kind of bounces off of and consolidates here for a while. And then if we break that 279 area, it's lookout below, probably down to this level here, right? 255. I don't know if we're gonna get all the way down there, but by all means we could, right? So I'm already buying puts expecting to make a lot of money off of that. And so this is the S&P or the SPY. We can go look at and see what the puts are worth. So I'm sorry, I'm buying calls. I'm buying calls because I expect it to go back up eventually, but you can see the puts are dumb cheap. They're $3. They're $3, $2, a couple cents, 55 cents, 43 cents, 26 cents in August. Now the likelihood of this hitting 140 in August is very low, and that's why they're so cheap, because again, the market goes down more than it goes up. But since that's the mentality, and since we have extrinsic value, puts become very, very expensive if you're right, because puts give you the ability to sell at a higher price than it gives you the ability to buy at a lower price, sell at a higher price, right? So that's why puts can be, they go up a lot faster. So let's say you had puts at 320. If you brought puts at 323 and it dropped all the way down to 324, you probably made 1,000% off of your contract. And I don't know if I can find one. Let's just look at like August. Let's look at the 300 puts. So the August 300 puts right now are sitting at $14, right? Let's look at their chart. Their chart went from $5.67 up to $18.92. So if we just do some really quick math, I can pull that up on my stock profit calculator. Let's say we had, I don't want this one. I want this one. We purchased 10 contracts. So how much is 10 contracts? 10 contracts is 1,000 shares, right? 1,000 shares. And our initial price was $5.69, right? We would have spent $5,000. That's the most we could have lost. Right now, it's sitting at 1505. That contract is now worth $15,000. A $15,000 contract. You spent $500, you made $15,000 in what, 1, 2, 3, 4 days, right? And that's just how it works. But you'll see that puts normally go down more than they go up, right? Because like we said before, we expect the market to go up more than it goes down. So if puts are the ability to make money when the market is crashing, and we expect the market to go up more than they go down, that's why you see that puts have this really, it looks like a penny stock, right? You'll see that it has these spikes and these valleys and these spikes and these valleys. And then if you actually get it right, you'll make a lot of money. So puts are cheap. You don't spend a lot of money. Even if you spent what? If you only had 10 contracts, you still would have made 164%, $93. It's not nothing to, cry about, but you can do 100 contracts and spend I'm sorry, not 100 contracts. I did that wrong. You could add 1,000, right? And still made $1,000 if you would have brought 10 contracts. So 10 contracts, you would have spent $569, and you would have been really good. You've been really, really, really good. You would add 164 return on your investment. So those are puts, and this one is a lot easier to look at because you can see the SPY. And if we look at it for the past like 5 days, or if we look at it even further than that, it kind of just slowly went up, right? So it kind of just slowly goes up, right? And so you'll see the dips. See, it does the same thing the chart is doing, but it does it faster, right? So this goes from 300 to 306. This goes from 36 all the way down to 24. That's a way bigger drop, but it mimics what the chart is doing. So if this is a put, we expect it to go down, but it's going up. So this goes down faster. But the one time it goes down and you get it right, you make a lot of money. This is how it works. It's a really good drink. All right, we have any questions? Ask away, guys. Please, please. If you can't ask questions in the chat, come to the YouTube channel. It's pinned. Come ask your questions in the YouTube channel. Tons, but I'm not right. Tons. No, guys, please. You got to ask. Listen, you got to ask questions, all right? Ain't nobody judging, because I had a lot of questions too when I first started trading, and I ended up losing a lot of money because I didn't ask questions. So I don't want you to go try to get an option contract because I'm sitting here showing you how much money you can make. You have to come up with a strategy, right? So I want you to ask your questions so you guys can go back and come up with a strategy to figure out how you're going to make money, and not just like taking the information, have it, and not know what to do with it. So please, please ask me questions, and I'm going to do my best to help you out based off of what's happened to me. I wish I knew how to do that on demand thing. Hold on, let's see. On demand, Thinkorswim. How do we do this? lets you replay the past trading day to evaluate your trading skills and historical data. How do you turn it on? Simulated trading. How do I turn it on? All right, that's what we're gonna do. How do you scan for option plays, or do you just play the SPY and other usual suspects? David, no, I said David. I'm sorry. Deidre, that's a really good question, and let's walk through that. That's a great question. So when you buy a put, say $15 put, I'm not sure of your question, Karen. Can you rephrase that for me a little bit? And I'll try to answer that one. But let's answer Deidre's question first, okay? So Deidre asked, how do you scan for option plays, or do you just play the S&P 500 and the usual suspects? So I'm gonna do a video on this channel, on the YouTube channel, very soon, and what I'm gonna do is take you through how I've come to the place where I am now, where I'm very comfortable making trades and investments. Okay, and so your question goes back to pretty much what I've learned over the past 4 years of trading. Basically, how I scan and how I play the market is based off of the rules that I've cultivated for myself and that I've found to be the easiest way for me to make money. And I've talked about those on stream before, and basically what it is I only trade. This is one of my biggest rules. I only trade very liquid companies, and I only trade the same companies over and over and over again. There's no rule. And this is the good thing about options, is options get you past day trading, because if you day trade and you take a L, and you take a big L, you can't trade that company again for 60 days if you want to claim the loss, right? So if I buy Boeing and I take a loss on Boeing, I can't trade Boeing again if I don't want to wash. With options, each one of these, so if we just look at Apple, each one of these are different trades. So if I take a L on the 190s, I can play the 195s. If I take an L on the 195s, I can play the 200s. If I take an L on all of the June 20th, I can go play July, right? So option trading gets you past the wash rule, because they're different trades. So when I switched over to options, it allowed me to not be afraid to make trades on the same company over and over again. So I trade the same 6 companies all year. That's my rule. So when you ask me how do I scan for option plays, I already know my option plays because I play the same options all year. I wish I could show you guys Boeing, but I've made $10,000 off of Boeing since March. I made money on the way down. I made money on the way up. I made money on the way back down. I made money on the way back up. And I'll show you why Boeing is such a great stock to play. It's very liquid, right? So when I say liquid, it has it's liquid. It has a lot of swings. So here we're at 186, then we drop all the way back down to 122, then we drop up to 166, then we drop all the way, then we eventually get back down to 127, then we're back up to 150, and then we get back down to 120. So the plays to be made in Boeing are really good plays because it swings so fast. So I can buy a put here for 600 and then buy here, make $1,000 off of that put, right? I can buy a call here for 1,000 and then make 3,000 by the time it gets here. So I play the same 6 stocks and I chart those same six stocks and I play them all year. One of the things that I talked to a lot of people about last chat is the reason why I do this is because if you draw a line right here, so we just put a line right here, the chart is symmetrical, right? So if you are in this company and you see this company every day, you already know what to expect. I expect Boeing to, if it does start to go back down, if it breaks this level, where's it at? So if it breaks this level here, this 153, I expect Boeing to go back down to 122. So I would buy 122 puts because that's what I expect, because that's where we were before we took off. So a lot of people in the chat are in our Facebook group are going to try to tell you to have multiple plays. Karen, I'll get right to you. That makes way more sense. A lot of people are going to try to tell you, a lot of day traders like, oh, you need to wake up at 5 o'clock in the morning because you need to scan the market and you need to figure out which has the most volume. And then you need to figure out where all of the stop marks are. And then you got to figure out where it's going to take off. You don't have to do that. That's stupid. That's how you lose money. You need to know your stocks like you know your back of your hand. That's how you make money. The more you know about something, the more likely you know how it's going to act, and the more likely you're going to make money. If you're getting into a company the day of that morning and you're trying to predict that it's going to run up that morning, you have no idea where it's going to stop. You have no idea if it's actually going to run. You have no idea what it's going to do. Like Hertz, no one knows what Hertz is going to do. Why would you trade that? I'm not trading Hertz. Not saying it's not a good trade. I don't know what it's going to do. So I don't know if it's going to give me my money back or it's going to take money from me. I trade stocks like I give money to people. Is this person going to give my money back? Yeah, I'll give them $20. Is this company going to give me money back? I'll give them $100. I don't know about them. I will watch Hertz to see if it starts with a pattern. Other than that, no. So your question was, how do I scan? I don't scan. I have a chart that looks like this, and I'll show you my 6 companies. It's Boeing, it's SPY, it's come on SPY, it's SPY, bro. What are you doing? There we go. It's SPY. It's hold on, I need to take a drink. It's SPY, it's Apple. Normally it's AMD, but I'm getting away from AMD and I'm going Zoom. It's Zoom. It's then there's one outlier that I'll normally play. I'll normally play like Datadog, or I'll play Datadog really hits 80. Oh my gosh. I'll play Datadog. I'll play like an airline stock, because airline stocks have good returns too. I'll have one outlier right here in the middle. And then my last, I cannot think of what my last one is, because I'm normally in BA or SPY for the most part. What is my last one? Oh, Microsoft. Oh my gosh, Microsoft. I always forget Microsoft. These are the only charts I look at all year. And the reason why is because look how much they swing up and down, and they go up more than they go down. And so I like to buy calls more. I like puts. So I like to find companies that go up more than they go down. And when they do go down, I like to know that I like to know where they're gonna go. So Microsoft 181 is probably where it's gonna go if it dips. It's not gonna go lower than that. And if it does, we're in a world of trouble. If it breaks 181, we're in a lot of trouble. The market is gonna crash. So now that I know that if Microsoft breaks 181, I know to buy puts on SPY. I know to buy puts on Amazon. I know to buy puts on everything, because if Microsoft breaks 181, that means we're no longer trading off of technicals. We're trading off of fear. Once you trade off fear, you trade puts. That simple. So that's why I only look at the same stocks all day. Boeing, SPY, Apple, Microsoft, Zoom, and Facebook. It used to be Facebook here, but Facebook took a lot of money from me, and I can't rock with it. Personal vendetta right now. That's just what it is. So how do we set up multiple charts on Thinkorswim? Come up right here in this corner, and you can set up a whole bunch of charts, but just right here. And then you can actually split your chart. You can pop your charts out by doing detach. So if you have two monitors, you can do detach. All right, so Karen had a question for us. Sorry, the puts become more valuable when it goes lower than the strike price. Puts become more valuable the same way calls become, the opposite way in which calls become more valuable, right? So it's 3 things you need to consider, right? And I'm sure somebody in the chat, I feel like I'm in class, but I'm sure somebody like a peer is already saying this in their head, right? We have time. Wait, Hector. Why are we not? Wait, what? Why are we not typing? Oh, that's why we're not typing. All right. So there's 3 things that are the reason why your premiums, right? It's your premium becomes more expensive or least expensive. Bro, I should have never made that drink. Time, price, strike. These are 3 things that are going to be how much your premium costs. How far away are you? Right? So how far away are you? What's the current price? Is it up? Is it down? Right? And then what is your strike? So the price of your actual strike. So if it's like 210, right? And then the current price is at like 200. All 3 of these things determine the value of your contract. So let's say the price goes up or down, but you're so far away from your contract expiration date, the cost probably won't move at all, right? Unless you get a violent swing where you end up being like 10 to 20% away from your strike, and then that is going to affect your cost. But if we go look at contracts, and I really want you guys to like study these contracts, right? So if we look at the puts, and you asked me about puts, right? Okay, puts. If we look at the puts for Boeing right now is at 189, right? If we look at the puts for Boeing, these are all out of the money. And is there a big difference between 182 and 180? Not really. Is there a big difference between 180 and 177? Yeah, like $200. That's a lot of money, but it's not a lot of money. But the further out the money you get, you're talking about 20 cents here. There's no difference between 147 and 146. This is July, so if you're really far out, like in October, this is 40 cents, this is 57, this is 77, this is $1. This is it's not a big, huge difference because there's so much time left on the contract. Now, if you're in the money, it's a huge difference. So this is 84, this is 76, this is 69 because that's in the money, right? So if you're out of the money, it's not a big difference. If you have a lot of time left, if you're in the money, it's a huge difference on based off of the stock price. But just remember these 3 things: time, price, strike is what calculates your price of your premium. Puts become more expensive with all of these things in consideration. What your strike price is, the movement of the stock, and then how much time you have. Okay. Delta, theta, and implied volume. Yes. Delta, theta, and implied volume. If you guys don't know what Noah's talking about, I highly suggest we look those up. I missed a question. What do I think about Monday? I'm so sorry I missed your question. I think we're down. You guys know you can look at the Dow futures Sunday at 6:00, right? So within like 24 hours, we'll know whether we'll have an idea, but I think we're going to be down, and I'll show you guys why I think we're going to be down. I kind of already showed you one time. How does volume impact trading, and how do you read volume? Okay, so that's not an option question. So I just want to make sure I don't have any more. I just want to make sure we don't have any more questions about options before we get in. Okay, I don't see any more option questions, so I'll answer that one now. Guys, make sure, I didn't plug the channel. Make sure you subscribe to the channel because we're going to be doing a lot of dope stuff on YouTube. Like, if you guys think this is informational, this is just me with a drink talking to you guys. I'm going to start putting out actual videos like how to set up a brokerage account, how to become a really good day trader, how to read volume, how to chart, how to know what's going to happen the next, like how do I know when to get out? How do I know when to get in? I'm going to be having videos about everything that I do. I'm going to put on YouTube. So make sure you hit the subscribe button so you guys can get notified when we make videos, and we all can become better traders together. Because like I said, we gotta get better together. All right. So how does volume impact trading, and how do you read volume? So I'll give you 2 answers. When I was a penny stock trader, when I traded penny stocks, I trade off of volume. There's a scanner on Thinkorswim that tells you about unusual volume. volume tells you a lot about a company. So Noel asked me what I think about Monday, and I'll tell you, there's a big tell to me right now about what's going on or what's going to happen in the market. Okay, and I'll show you. One is these two spikes have on Delta have all gone back down to $20. Okay, these have all gone back down to $20, and they're big red candles in the aftermarket. So aftermarket is very volatile, but there means that there's sellers all the way down to 22, but there's also buyers down here. So these four lines right here are very scary to me, mainly because if we break this level, we're probably going to crash again, and people right now are defending it. Okay, so I think next week, Noel, to your question, we're going to be down, mainly because the things that are bouncing should not be bouncing, and that's scary, right? So Delta's down. Yeah, it's not 37, but if you look at today, it tried to go down, but it somebody fought here and it got back up, but it didn't get back up on good volume. So if you see, we had a really strong candle, a really strong volume here on a red candle for selling, right? So people were really trying to sell, but there were a lot of people trying to buy at the same time. So we ended up with a red candle, but the next big candle was a lot of volume, right, on this 5 minute. But if we go to the 15 minute, it tells a better story, right? So this 15 minute, you have your deviation is almost symmetrical. So you have just as much sellers as you have buyers. Maybe you have a little bit more buyers, right? But this next candle is kind of telling me we have the same. So you have just as many sellers as you have buyers here, right? Where we open, where we close, but your deviate, it's almost perfect symmetry here. Then I have a red candle, big red candle, but not a lot of volume, and it just fights. You see, Delta is just fighting, right? But why is Delta up? Delta shouldn't be up. You know who should be up? Amazon. But Amazon is down a lot. Amazon's down almost %, but not really, because I mean it kind of fought it off. But Amazon is down. Microsoft is down. The SPY is down. NASDAQ is down. NASDAQ has been killing it. So when you look at that type of stuff, you look at like what's up and what's down, you can see that there's a battle going on right now between people who it's with NCL. I don't even know Norwegians. I don't trade it. Norwegian bounce. There's no reason for Norwegian to bounce. You cannot sell any ships until July. And if there's a second wave, yeah, Jazzy, the thing about Tesla though, Tesla does what it wants. You just got to put your money in Tesla and just like put it in a different account and just never look at it and just keep putting money. Like Tesla does what it wants to do. But if you look at Norwegian, the cruises can't come back until July, meaning that there's no ship selling. They're sitting at the docks and nobody's making any money. Ain't nobody buying cruises right now. People are barely flying. So I know no one's buying a cruise, but for some reason, Norwegian went from $9 all the way up to $27, and now it's trying to make its way back down to probably 12, right? But for some reason, Norwegian Cruise Lines fought off the lows. We have a double bottom here, and it fought off, fighting back down to 16. Why? Because people are buying for no reason. The stuff that should be up is down, and the stuff that's down is up. So what that means to me is we're about to have a sell-off, and there's a lot of people who are going to go broke because the SPY is down, and it's okay. But if you look at the dip, look at the initial dip, SPY went from 329 down to 217. Okay, then it just immediately fought back up, and it stayed up. This is the same pattern that tech had. It's not the same pattern that travel had, right? Our finance, our consumer goods, our hospitality. So that being said, I think tech, you're fine. Hospitality, the Dow, I think hovers around 23, 24, but you're going to see cruise lines, travel, hospitality, consumer goods, fashion, all tank again. That's just my opinion. So I'm playing puts on financials. I got puts on financials, and I have calls on tech. That's my play. Yeah, we made. I didn't make money off of gold. I can't trade gold. I have a lot of boys that trade JNUG and made a lot of money off of JNUG before they made the split. Gold is a good call. Gold is a really good call right now. Gold is a really, really good call, in my honest opinion, right now. Do you put stop losses on all of your long holds? Nah. Karen, so I only have, that's the other thing. So guys, if you're here for options, I think we're done talking about options at this point. But on my long holds, I only have 4 long holds. These are the only 4 companies that I hold. I hold 4 companies. I hold Apple. My average in Apple is 296. I have 100 shares. I hold KNSL, which is an insurance company. They pay out dividends. Really great company. I'm not telling you guys to get in this. Again, I'm not your financial advisor. Do as you please. Trade at your own risk. Invest at your own risk. I'm just telling you guys my portfolio. I have Apple. I have KNSL. I have what else do I have? I don't know what else I have. Wait, I think I sold everything. Yeah, that's the only 2 companies that I own right now. Those are the only 2. I sold everything else. So do I have stop losses on all of my long holds? Absolutely not. I don't have a single stop loss on Apple. Every time Apple dips, I just buy it. So I've been waiting for a pullback at 354 to buy more Apple, and I'll show you what I mean by that. I think I have something I can show you guys. Let me see real quick. See if I have it. I have all my positions in Apple somewhere listed. Okay, yeah. So this is my position in Apple. I'm perfectly fine like showing you guys this. It doesn't like, it's not that bad. These are all the shares of Apple that I own. So when you say long holds, like if I'm holding for a long term for 2 or 3 years, like I'm holding for 2 or 3 years no matter what. I just keep buying. So you'll see I bought on January 2nd, the 9th, the 24th. February, I brought 2 weeks in February. I brought 3, 4, 5 times in March because that's when the dip was. I brought again in April. I brought again in June. I'll probably buy some more in July because it's dipping. So I just continue to buy. I continue to buy the good companies over and over and over again. And that's how you'll see like here, I made 300, 100, 500, 300, 500. And this is how you accumulate shares and make a lot of money. You invest a lot of money, but you treat it like your savings account. So I'll have a video on this channel, on my YouTube channel soon, to explain to you why this is how you invest, right? Even though it all says short, it's because like I've only started my position in Apple this year, but I plan on holding these positions for 2 years. So why would I just put like $5,000 in and let it rock? If it's something that you plan on holding for a year, just buy shares, buy 3 shares, 2 shares every now and then, and you'll see that like you're not going to lose money because you're already planning on holding it for a long time. So just go ahead and keep averaging down, keep buying more. So when you are ready to sell, you're going to make way more money than you would have if you would just put that initial 5 in and just let it sit. Take your paycheck and like take a percent out. Like say, all right, every paycheck, I want to buy 1 share of Apple. So I need $300. Take that out. As soon as you get it, buy 1 share. And then by the end of the week, by the end of the month, you'll have 4 shares. You have 2 shares if you get paid bi-weekly. 4 shares if you get paid weekly, and then by the end of the year you'll have 48, 50 shares making money. So no, to answer your question, I know all my answers are long. I don't have stop losses on my long holds. I only have stop losses on my trades. Wait, did we lose the live? I think we lost the live, guys. Wait, did I lose the live on you guys? Hold up, YouTube. I think we lost the live audience. Are you guys still here?
Wait, did we lose the live?
No, okay, they're still here. All
I
right.
think we lost the live.
All right. I just want to make sure you guys. I thought I lost you guys. All right, let me check the YouTube. Do you do credit spreads? Are you mean like selling? Are you mean like, I don't know what you mean by credit spreads, Noel. Do you mean like margin? So I had brought cheap OTM puts for NKLA for 20 cents, and that bad boy went up to $2. I tried to sell when it ran up, but the order stayed there until it dropped. Is there a quicker way to trick? Is there a quicker way or trick to sell? Okay, so let's look at their options. And so remember when I was saying, you remember when I was saying that I only trade stocks that are very liquid? That is why. So what just happened to you is why I only trade very liquid stocks, or contracts. This was great. Thank you so much for doing this, Karen. No problem. Thank you so much for coming by. Make sure you guys come to the YouTube, hit that subscribe button, because we're going to be doing this more often. For Juneteenth, I'm gonna tell you guys right now, Juneteenth, I'm going to be live trading. I'm going to come on my YouTube and I'm going to just sit here with you guys. I'll be up at 8:30 in the morning, Central Time, and I'm going to live trade. I'm going to be telling you guys all of my trades that I plan on making. If I execute one, where I'm executing it at. If I'm just watching, we're going to do everything live. So make sure you subscribe to the YouTube. Noel, so back to liquid trades, right? So when stock is liquid, it's easier for you to get in and out. When it's not as liquid, it's harder for you to get in and out. NKLA just IPO'd, and so they probably don't have as much liquidity as, like, let's say a SPY contract. So if I look at their contracts, I don't know if I can see their volume on here, but if I look at like the October volume, because you probably could have made a lot of money off of that. That's the company. Let me see what their contracts are like. So they're selling like 35, 100. I mean, it's not hard. They're not horrible, but basically what happens is, why you couldn't get out your trade is, if I have one radio, right, and I want to sell this radio for $100, but no one is willing to buy it for $100, now I have to do two things. I either have to drop the price or I have to wait for a buyer, right? So it's the same thing with stocks. Stocks only go up and down based off of people buying and selling. So if there's no one there to sell at the price that you're trying to sell at, you're going to have to wait until a buyer comes in. And then if there's just no one buying or no one selling, then your trades won't go through. And that's what happens with a lot of contracts that are in liquid stocks. There's just no one there to buy your contract. And it happens a lot with penny stocks too. Like if you buy a penny stock and there's not a lot of volume, a lot of people trading, you get stuck in that stock until someone buys your shares at the price in which they're listed for. So that's why market trades are very dangerous, because if you trade at market in a non-liquid stock, you don't know what price you're going to get. Someone can swoop in and steal your stuff at market price, which is way lower than the price that you actually see on the chart, because the bid and the ask are so far apart from each other that you don't know what price you're going to get. The seller can literally say the market price is $2 and it's at $3 right now, and you're going to lose $1 per share. So when you're in non-liquid companies, it just happens. So you have to be careful buying contract for stuff that aren't liquid. All right. That's why, again, I only trade those 6 companies. They're very liquid companies. Zoom is liquid. Boeing is liquid. Tesla is liquid. Facebook is liquid. Amazon, SPY, Microsoft, all those. As soon as I want to sell, there's always a buyer. There's always a buyer. What's the most profit day trading, short or long? What is the most profitable? I don't like to pick a side because I do both. especially since working from home is a thing now. For me, that's a good question. I think sometimes day traders take their best days and it becomes like a drug to them, because you get that you get those chemicals flowing in your brain, just kind of like the same thing in Vegas. You're like, oh, I can do this every day. I can make $5,000 every day. I'm a bomb day trader. And then you get that day where you lose 8, right? So if I had to pick which one is more profitable in the long run, I would say investing. Going long is always going to be more profitable to me. And the reason why it's more profitable, because going long, you don't lose as much money as you do trading. I've never lost $5,000 going long, ever. I've lost $5,000. I lost $5,000 on Thursday in one trade, Facebook. But I mean, I also made $12,000 in one day too. So, I mean, if you average them out, I think going long is always the way to go. And you should never be a 100% trader. I am actually 80% of my money is invested in long term. And then 20% of my money goes to day trading. And whatever I make off my day trades, I take 50% of that and I day trade again. And I take the other 50 and put into my long investments. Let's see. Let's see if I have any questions on YouTube. Gotcha. Thank you, Chief. Hey, appreciate you for coming by, bro. Appreciate you guys for asking questions too, man. This is dope. I like this. This is real dope, man. So let's do, we still got a lot of people watching, which is really cool. Long swing day, least risky, most risky in my opinion. Yeah. So to say all that, to say this, right? No matter what you do, whether you're long, whether you swing, or whether you trade, you can do it all with options. I think there's really only two, in my opinion, now that I trade options, there's only 2 routes that I would take with the market now. I would only take options and investing as the only routes in which I would even be in this market. When you short, like you actually short a stock, you have way more potential of a loss than you do of a gain, right? So if we look at it, if we get rid of this and we take a chart and we draw it out, and you guys are gonna start to love Photoshop as much as I do if you come here enough. If we short a position, let's say we get in here at $0, right? And this is the max. We have a max down here. The thing about the upside of shorts is it's infinity, right? So if I get in, my green arrow stops and then it flatlines, right? That's the most I can make. It stops down there, and I'm in the money. So if I short a company at $1,000, the most I can make is $1,000. But if I short at $1,000 and it can just go up like this. So I would never actually try to short a stock. I think whenever someone tells me they shorted something, it immediately, and I hate to say this because this is how people are, right? I immediately say they have no idea what they're doing, because if you think a company's going to go down, hey, Jassy, thank you so much for coming by, and thank you for the subscription, man. Or ma'am, thank you so much for coming by. I appreciate it so much. Thank you. Thank you for the subscription as well. We did really well, guys. We have 30 subscribers already. We don't even have a video yet, so thank you. But basically, on a short, you have a max that you can make, right? You have max profit and uncapped loss, which is very dangerous. So if you're shorting, like actually shorting a stock, this is the way to do it. Options are always the way to go, because with an option, it's the same thing. You just buy puts, and puts, the most you can lose is your premium, right? That's the most you can lose, but you have a way higher max than you've capped off your loss. And that's what you want to do as a trader. You always want to cap your loss and try to get as much profit as possible and cap your loss. When you short, you can't cap your loss, which is the wrong way to go. right? So if you're going to trade, I would say trade options. Trade options. I never ever trade cash or trade stock. I only trade options. It's the only way to go. It's literally the only way to go if you're trading. In my opinion, like, it's just the only way to go if you're going to try to trade. But again, you need to have a long position in something. Options I think are also the least risky too, because there's so many different things you can do with options to cap your loss. Swing trading, I think swing trading is more profitable than day trading. And I think yeah, I agree with you, Noel. I think it's long swing trading and then day trading. I think day traders have way more heart than I have. I can't do it. I can't do it. Can't do it. It's not for me, man. Any more questions? Because if not, I'm going to show you guys the Excel sheet and I'm going to get out of here. And then I'm going to start trying to figure out what videos to put together for you guys. All right, bet. Okay, so here we go. I'm going to show you guys the sheet I want to give you, but we're going to do this once we get to 1,000 subs. That's my goal. Okay, I know we're far away. We only got 38, but I'm filling you guys in on all the things that I want to do. Okay, so before you start investing, there's something that you need to do. You need to figure out how much money you can invest with. No, go ahead and ask your question now, bro. If you got a question, go ahead and ask. I'll stay around as long as we got questions. I'll kick it as long as we got questions, man. Like, this helps me. Like, you guys don't understand. Like, just being here watching helps me out a lot. So, it makes me a better trader. So, I have a sheet that I use that helped me get to where I am now, to where my portfolio is where it's at. It also is the reason why coronavirus didn't really affect me. I mean, I didn't lose my job or anything, but if I did, I would have been okay. I'll say that. So this is a sheet that I have in Google right now. And it's a sheet that I want to give to you guys. Once we get to 1,000 subscribers on YouTube. Okay. And so I'll show you guys. Anthony says, how do I know what limit price to place on a call option? We'll talk about that next. We will talk about that next. So this sheet is a household breakdown. And so basically the way this sheet works is you put in your net income, all your bills, and then how much you want to save. So I can have a bill, like you see I have personal money up here. I can also have a bill like investments. And every month I can say how much money I want to take out of my check to invest. So I can say like $1,000, right? You'll see the numbers automatically change. And I can tell you how much I want to save. This sheet is going to automatically tell you what percentages that you need to have as a direct deposit out of your check. So all of my money that comes out of my check automatically goes exactly where I need it to be. And I never have to do anything myself, right? So 36% of my check does this, 30% of my check does that. This is how much I'm going to make. This is how much my yearly savings are going to be. This is how much my household. So this sheet breaks down a 2-person household, what your bills are, what you guys pay together, how much goes in the joint account, all that stuff. I'm going to give you guys this at 1,000 subs on the YouTube, right? And this helped me tremendously to know, oh man, my cell phone bill is too much, or this is too much, or if I really want to make money, I got to stop doing this because it's taking 36%. Like my bills are 36%. And so you can figure out, okay, I want my living means to be at 25% of my check, meaning that a quarter of my money only goes to living, and then I have 75% to go to savings, investments, or whatever, right? And you really should be under 50. Underneath 50% of your monthly bills should come from your income, right? So you shouldn't be over 50. If you're over 50, your cost of living is way too high, right? And so this breakdown helps you with all that stuff. So financial literacy is what we need to preach the most in our community, and it's what we have to get better at. And this Excel sheet that I'm going to give to you guys helps you get there. Okay. like knowing all of this stuff really helps you get there. It literally breaks down all your bills, how much you're gonna make in, and all that stuff. So at 1,000 subs, we're gonna give this away, all right, for free. So let's go back. How do I know what limit price to set for call options? It's no different, Anthony, than a stock. You need to set your rules, and we'll talk about this in a video. You need to have rules. Like, rules are important, bro. Like, I can't even type it big enough to explain to you how important having rules are. Like, you need rules. And the reason why you need rules is because they make you a better trader. And it makes you more profitable. If you're playing the market and you're just trying to guess when to get out and when to get in, you're not gonna know. You're gonna lose more than you win, and you're not gonna know why you're losing. So rules allow you to say, oh, that rule doesn't work, or this rule isn't good, or this isn't good. But if you're just out here swinging it, you're gonna catch L's and have no idea why you're catching L's. So let's look at the S&P, or let's look at the SPY. Let's look at Boeing. Boeing is charted way better. Oh, I'm not on my account. Oh, crap. Okay. Let's just look at Boeing really quick. So with options, you need to know how much you're trying to make, and how much you're trying to make, and where the underlying asset you feel like it can go. Okay. So if I buy a call in Boeing, I have to know, where do I think Boeing is going to go? Okay. Well, I'm going to chart Boeing. And figure out, okay, I think Boeing can maybe go back up to 210. Is at 190, 189 right now, right? So if it's at 210, how much out of the money am I gonna be? Am I gonna be $20 out of money, $40 out of money, $50 out of money? What does that premium look like? I'm gonna go look at other contracts to see what their premium is like, $20 out of the money. I'm gonna set my limit there. But with options, I'm gonna be honest with you, I don't set limits. I don't set limits on Jazzy. I'll get to you really quick. Or right after this. I don't set limits on my profits, and I know I probably should, but what I do is when I'm trading, I take half off. How do you say this? I'm trying to figure out how to phrase this for you. I'm gonna say this and start to the beginning because I missed it. Bet, Cassandra, thank you. All right, I figured it out. So Anthony, what I do is, let's say my strike price is 250, and I think it's gonna get back up to 220. I need to go figure out what those calls look like. $30 out of the money. What calls are like $30 out of the money? Are they at $15, $20, whatever? And I'm gonna set my limit to be normally around that price. But again, I don't set limits on my cap. When I'm day trading, I trade based off of the movement to lock in gains. So I'll take you through an example. What I do use is trailing stops. Once I'm so much in the money, I put a trailing stop on half of my contracts. So for example, if I would have got into Boeing here at let's say 180, and I got calls, and I said my calls are going to be for 200, and I just get real lucky today, right? I just get dumb lucky. This is not it. Where's it at? I get dumb lucky here, right? And I'm like, okay, I think we're gonna get up to 200 within the next week, but then it literally shoots from 170 all the way up to 90. This candle here, this is a weird candle. I would say this candle here, I would have had a trailing stop for half of my actually it's really, I normally do it after the third candle. There's a pattern called three white soldiers. This isn't technically it, but it's close to it. After I see three white soldiers like this, I would have had a trailing stop on this. So once it got up here and then dipped, half of my contract would have been sold. I would have been in profit land up here, right? I probably would have been up I probably would have really been up like 10% up here, right? I'm up 10%. Why would I not take profit? Go ahead, set a trailing stop order for like 5%, 10%, or 20%. Or you can do like 20 cents, 20%, however you want to do it. And literally what's going to happen is your stop order travels with the stock price. And whenever the stock price, it dips below your stop loss, it will sell. So half of my contracts would have been sold here, and I would have rolled this out, and then once I probably would have got here, I would have sold the other half. That's just how I do. I have limits on my sales, but not on my I have limits on my loss, not on my sales. Jazzy said SPY versus SPX. So if I am saying this correctly, the SPY is an ETF and the SPX is an index, which are two different things, right? So I don't even know if I can look up the SPX. Okay, I can't look up the SPX. They're almost at the same exact value, aren't they? Yeah, they're literally at the same exact value. So this always confuses me too. I trade the SPY, but I believe the SPY is an ETF for the S&P 500 and the SPX is an index, which are different things. So yeah, I don't know if that answered your question. I don't know if you was asking a question, but yeah. Bank puts running up. Thank you so much for sharing. Huh? Thank you. What platform am I using? I am using TD Ameritrade Think or Swim. So I think you have to, it's $50 to start an account with TD Ameritrade. I actually don't trade with them, even though I probably should. I trade with Fidelity. But their platform is really good for charting and it's really good for scanning. I used to scan back when I day traded. I used to use the scanner all the time. I don't use it anymore. I hardly touch the scanner. I trade my same 6 stocks every day. That's just what I do. I used to use the scanner every day trying to find like the next big thing, what penny stock was going to run, what company was at 52-week highs, what volume was changed. Nah, not doing that anymore. That's not what smart people do. Smart people trade the same 6 stocks or same stocks all over time, like all over and over all the time. When you listen to investors, they literally talk about the same stocks over and over and over again. And that's because they don't care about anything else. They found the gold and they're rocking with the gold. Thanks for the information. Hey, Anthony, I appreciate you for coming by. Not aftermarket hours preferred. I'm sorry, Jazzy. I'm not understanding stocks. I've been bouncing around. What do you mean not aftermarket hours preferred? The SPY isn't visible. Oh, the SPX isn't visible after hours. Huh. Yeah, you know what's crazy? I actually just started trading the SPY. Oh gosh, I don't want to talk about GUNS. So the only reason I trade SPY is because it's a really good indicator for tech, for Microsoft and Apple. So like, and it's very liquid. I know it's an ETF. I don't know like too much about. I know what companies are in it. I don't know how it compares to SPX though. Oh, if I had a preference. Is it possible to grow account strictly from out of the money plays? I only do out of the money plays. I never do in the money plays. In the money plays cost too much money because they're in the money, right? I only do out of the money trades right now. Oh, do I have a preference? SPY is my preference. I see what you're saying. Yeah. SPY is my preference right now. Out of the two. GUNS. I don't even like Genius Brands and like, what do they do? What do they do? I'll give you an honest opinion. I read a call on SPX and it was like hot grease. I mean, it looks like it moves with the SPY though. Genius Brands is an international. Genius Brands International. Oh, international. Okay, it's an entertainment company head by Andy. The company was formed. Okay, but what do you do? What do they do? A2. I know who A2 is. kind of like Netflix for kids and cartoons. TV series deal. You know what's all right? I'm just gonna be real with you. The fact that this is their Wikipedia page means it's not investable to me. I'm just being real. And that's how fast I'll make a decision off of a company. I just between 18 entertainment taking over top executives pretty much. Baby genius, huh? This Wikipedia page has less words on it than my friend's page that went to the Canadian Football League, and he only played 5 years. This is supposed to be a company. I can't do it. It's not enough information. Like, it's literally that easy for me to make a decision on if I want to put my money in your company. This chart is also a really good indicator that I don't want to put my money in your company either. Not yet. It's not investable for me yet. You guys ever watch Shark Tank? You ever see somebody come up with a really good idea and the guys are like, oh my gosh, you just need a little bit more time, a little bit more, like your model is there, but you're not ready. You're not investable yet. You got to be like a shark. Is Genius Brand a good investment? Maybe. When though? Do you want to put your money in it right now? Could your money be serving you somewhere else? Like if you put $1,000 in Genius Brand right now and it takes 10 years to get 40%, was it worth it? Could you have put that $1,000 into something else for like 4 years that you waited it and made more than 40%? That's how you got to invest. Like, is it worth it right now? And for me, I mean, yeah, 2,000%, that's insane. That's crazy for the people who got 2,000%. But I can't risk going from $7 down to $3 right now. I can't risk a 47% loss on a company that never had a shot. You know what I'm saying? I just can't. It doesn't make any sense. If they hit like $15 and they start and their Wikipedia page gets a little bit longer than this, we'll talk. We'll talk. You need to get some more words on your Wikipedia page. Great music. Hey, appreciate you, Luke. Is it bad to trade during an extended? Okay, I'm sorry, I'm missing some stuff on Facebook. Is it bad to trade during the extended hours? It's not bad to trade during the extended hours, but you need to know that extended hours trading is very volatile, and it can be up to 300 and down to 200 in a matter of seconds, and it's very hard to get your orders through. So extended trading hours is is extremely volatile, and it's almost like the lawless wild west. You can lose a lot of money very fast in extended hours. So just be careful and manage your risk in extended hours. Okay. It's not a good or bad thing. There's they have cartoons. They have Stan Lee's last project, which Disney is interested in, and it partnered with Warren Buffett. Okay, so Logan, this is the issue. All those things that you listed are great. Don't get me wrong, right? They're amazing things. But it's not a business. You, at the end of the day, you guys have to invest. If you're talking about long-term trade, if you're talking about trades, cool, that works. If you're talking about investments, that's not a business. You got to invest in businesses. This is the difference between a trade and a business, right? Let's take Wingstop. Let's go for, I love Wingstop. If you guys were my friends on Facebook, you would know that I love Wingstop. Right now, I'm not investing in Wingstop anymore just because I made a lot of money off of Wingstop. I made a really good money off of Wingstop. And right now, they're just Wingstop went from 44 all the way up to 130. This is an investable company, and I will walk through and I'll explain why. Okay. I actually don't even have to walk through and explain why. I can tell you off the top of my head why Wingstop is nasty. Hold up, who is this? I'm about to block you. Come to my chat slandering Wingstop. Wingstop is delicious. But this is why Wingstop's a good company. One, Wingstop only has 5 people working at a time. So if you're paying those 5 people minimum wage or even $10 an hour, you're paying maybe $50 a person because they're only working 5-hour shifts. You're paying like $50 a person. Not a lot of money. They only need 5 people to work in their restaurant at a time. Okay. The average Wingstop order is $8. So pretty much one order automatically takes care of somebody's pay for that day, right? They're in very cheap real estate. You will never find a Wingstop in extremely expensive real estate. Like you won't find them in high-end shopping malls. They're in very cheap, affordable real estate. So not only do they do not need a lot of people working to run their businesses, they also aren't in expensive real estate. They have an extremely usable web interface that allows you to make orders online without having to call anyone, meaning that the people don't have to stop working to answer phones, which is productivity. 80% of their orders comes through a digital channel, right? So when coronavirus hit and everyone else was trying to figure out how to do takeout and how to take orders in through their online interfaces, Wingstop was already there. So that's why you see Wingstop bounce down from 40 when the market sold off up to the all-time highs. They already had digital conquered. That's what they did. I can go order 25 wings right now. Don't have to talk to nobody. It's going to take me 2 seconds. Boom. It's going to tell me when to pick it up, right? So not a lot of people working. Very low real estate. Digital is on point, and they're just experiencing growth. They only have 1,700 stores right now. The CEO is trying to push to 26, and they're trying to go international. So if you take what they're just making right now and bump that up times 2, Wingstop then goes up by 200% based off of their revenue. That's a company. That's a business model. I can break that down and tell you that this is how they're making their money. There's nothing wrong with saying, oh, they're partnered with Amazon, oh, and major cable providers, oh, and Alibaba, and partner with Warren Buffett. That's cool, but how much money does that bring in? Is that a business model, or are they partnerships? Because I can tell you right now, on Semiconductors is partnered with a lot of people, but look at their stock. It bounces between $20 and they're partnered with a lot of people. They have a lot of people use On Semiconductors, but they ain't make nobody no money. But they have a lot of partnerships. A lot of people use them, but they don't have no money. So partnerships are cool, but do you have a business model, right? Can I break your business down to a point to where it is making money? Because that's what I'm trying to do, make money. I hope that makes sense. How far out do you hold sell trades? I've noticed that the theta starts kicking my butt around 25 days or less mark. Yeah, so when I'm day trading, I normally do about 2 months out on my options, and then I try to be out within like a week or two on my swing trades. Like I really try to get in and out within like a week. If I can get out that day, I'm out. So I don't hold my option trades for that long. So like next week, I expect the market to be down. If I get a spike, I'm out. I'm gonna be out, and I'm gonna reassess. So like if Monday, so I got puts in travel and consumer goods on Friday, and I got calls in Amazon and Microsoft for the long run for like 3 months out, but I got puts for the next month or two. If we drop on Monday, I'm getting out Monday. I'm not gonna risk it. I'm gonna get out Monday and reassess what's going on. So I don't hold them for longer than like a week or two. That makes sense, kinda. They're manipulating it too much right now. You think they're manipulating Wingstop? Man, Wingstop. Listen, I have pictures. Okay, this is the other thing I suggest you guys do. Go into companies and look and see who owns them. So I went into Wingstop, and I went to a few Wingstops, and they have their plaque on who owns them. You can go search for those people. That's what I do. These people are millionaires that own Wingstops. Why are there really big groups of people? In order to own a Wingstop, you have to have $400,000 of liquid assets. I mean, you have to be able to touch $400,000 at a moment's notice. You also need at least $290,000 down to finance your store. So off gate, you know the person that owns Wingstop has at least $600,000 ready to go and ready, right? So the people who own Wingstops aren't broke, and broke people normally know how to make money. So go with the money. I don't care if they're manipulating it. Why would I not? If they're manipulating, like, let them rock. I'm a manipulate. Like, I'll be there. Chipotle is. You feel me? Like, you see Chipotle stock. Chipotle's at like $1,000 and some freaking change. Or did they dip? Oh, they finally dipped. Okay, but Chipotle was at like 130. Look at this. Chipotle ain't better than Wingstop. I don't care what none of y'all say. I brought in at 1.15 and sold some at the top, still holding some. Thanks for the legit info. Yeah, I mean, like I said, guys, at the end of the day, if you're making great trades, then if you're making great trades, make great trades, right? But when you ask me about investments, I have to, even if you're mixing them up by calling your trades investments, I'm going to think like an investor. GNUS is not an investment for me right now, meaning that I'm not going to take my investment strategy into GNUS. I'll take my trade strategy into GNUS, meaning that I'll come in here, right? And I'll say, okay, all right, it was at 5 cents. It got all the way up to $11.07. And then, okay, the volume is nuts, right? So boom, 400 million shares were traded at 11. All right, so I'm going to take a trader strategy into this. So I'm going to come in here. I'm going to break the chart down on the 15 minutes. I'm going to see these big dips. I'm going to see consolidation here. Okay, we got a double top. Okay, we got a head and shoulders here. All right, we got a reverse head and shoulders here. That's normally bullish. Okay, next day, what do we do? Boom, we go up. So I should have brought down here. Like, I'm going to take a trader strategy into it, right? An investor strategy to me, I already showed you guys what it looked like. It looks like the Apple photo that I showed you, where I just kept buying no matter what. I'm not gonna buy GNUS or Genius Brands International no matter what, right? Because if I was buying no matter what up here, I would have been pissed when it dropped down to $4. I would have got out because it's not investable. But if Apple did this, I would be licking my chops trying to buy more Apple, because Apple is an investment. So if you ask me about a trade, it could be a great trade, but is it an investment? No. Are people still buying wings from Wingstop? Yes. It was jam-packed the other night. Wingstop was the club when coronavirus was popping. I'd pull up at Wingstop and it'd be the whole parking lot would be a club. People were out there getting the wings, man. As a novice, what advice could you give to someone looking to make about $200 a day? As a novice, you're trying to make $200 a day, I would say don't do it. But I also don't know your financial situation. If you're trying to make $200 a day, you gotta be willing to risk losing $500 a day. If you can't risk losing $500, then you're not ready to make $200. That's my rule. If I can't make at least double, if I can't lose at least double what I'm trying to make, I'm not ready. That's my general rule. But if I was you, right, and I was trying to figure out how can I make $200 a day, because my goal a day is $1,800. I hardly get to make $1,800. Some days I lose $5,000. Some days I make $2,000. That's just how it goes, right? But my goal is $1,800, but I'm okay losing 4 to 5 because I know my goal. I would find stocks. I would watch a stock like a wolf watches it prey, and I would figure out how much I need to put in that stock to make 200. So for example, I always show everybody Zoom because I made a lot of money off of Zoom because of how it trades. So if you look at this right here, you see how Zoom is doing, and I can draw the box for you to show you how I chart. If you're trying to trade, you gotta learn how to chart. You have to learn how to chart, and I'll have a video up. Explaining how to chart soon. But you see this box here. If I'm trying to make $200 a day, I'm studying this box. Zoom at one point was going from 120 all the way down to 104. I was buying $10,000 to $20,000 worth of Zoom at 103, and I was riding that joint all the way up to 120. And look how many times it did it. I would ride up to 118, 119, 120, and then the best thing about this, if you're really confident in your trade, if you're just like, I got this, I got it, I know Zoom is never going below 123, and if it does, I'm going to buy more. If you're really confident, you can trade it up, trade it down. And that's what I was doing. I would trade up to 118, and I would buy puts and trade it down. As soon as it hit down to as soon as it got to like 105, I would get out my trade, and I would buy to go up, and then I would sell to come down. I was just doing this up and down, up and down. And then you see this consolidation here. So you see how the swings aren't as violent. They get a little bit shorter, right? And then it comes down, and I had this big candle, and then it comes back down. That's called consolidation. So this chart here told me consolidation was happening for a big move. And then what do you think happens after that? We shoot the crap off. And I was in Zoom here at 103 because that was my price. And I took it all the way up to 172 because of this range told me that. So if you're trying to make $200 a day, you need to figure out how much you need to invest, what stock you can invest in, and how well you know it, and how much does it need to move for you to make 200. And then you execute your rules. Again, what did we say? Rules. Figure out your rules for every company and trade your rules, and you will minimize your losses and maximize your gains. You got to know when you're ready to get out. So like for here, I said if Zoom ever comes down here to 96, I'm out. And I ended up getting out, and I lost some money, but I kept making money, so I didn't care because it did drop down. I had to get out because I didn't know what it was going to do after that, because the last time we got here, we fell. So luckily people bought back, but I traded my rules, and I just kept making money every day, same thing every day. That's what I would say for you, Floyd. Like, find one company or two companies or three companies, stick to those same three companies and trade them over and over and over again. And I'll give you a really good one. AMD is a really good one. Look at this. This looks just like our other chart, don't it? This is your range right here. So hold up, let me extend this. This is my range in AMD. Don't let those things that like kind of go out this range, like these are just kind of like outliers, right? But you'll see, like, every time it goes out here, what happens? We double topped up here. We double topped, boom, it goes right back down. But this is your trade zone. I'm buying down here, I'm selling up here. Buying down here, selling up here. Buying down here, selling up here, right? You get used to that. Get used to that range. And this is why you have to do it. And this is why you have to trade really good companies, because AMD is a really good company. It's not going to just go from $11 to $4. It's going to maybe go from 58 down to 51, but then it's going to go back up. This is why good traders trade these good companies, because you don't lose a lot of money. Like, what is it going to take for GNUS to go back up to $11? More speculation? Are they going to have to nail a deal? Are they going to have to come up with a big contract? Maybe. Probably, more than likely, but AMD does this every day. Every day. You can make money off AMD every day, and that's what I do. $1,000 here, 1,001 here, get out. $1,000 here, 1,001 here, get out. $100 every day, over and over and over again, man. So my rule to you: find a stock. AMD's a really good one. Zoom's a really good one. Datadog is a really good one. So Datadog is also a really good one. You'll see that it kind of does the same thing, but Datadog goes up way more than it goes down. But this range was what I was trading here. Just this, I was trading that a lot. Find the stock that you can figure out the pattern, trade that pattern over and over and over again, and figure out when you're going to get in and when you're going to get out. Genius Global is definitely an investment stock, but possibly a great trade. Possibly, yeah, for sure. You just got to figure out how much possibly, like, how much can you actually deal with. I need that lemon pepper. I mean, Jassie's on it, bro. She knows. Jassy knows about that lemon pepper, bro. I'm new to this, so I'm learning, and I appreciate the info. I'll take anything I can. And Wingstop is fire. Always hit the spot. Wingstop is fire. That's why we gonna kick Misha out. Wasn't her name Misha that came up in here talking out at slander about Wingstop? I'm kicking her out, bro. I'm blocking her on Facebook. Ain't got no time for that hateration, holleration in this dancery. Ain't got no time. All right, guys, we've been going for 2 hours and 30 minutes. I definitely know where we need to be. I appreciate you guys coming and hanging out, but my fiance back there, and I'm sure she wants to go to sleep. So I'm going to hop off because it's 11:22 here. I appreciate everybody coming out. We're definitely going to do this more often. Friday, Juneteenth, I will be doing live trading on this channel. So make sure you come over to the YouTube channel, because I am going to be doing live trading on my YouTube channel. Okay, so I'm going to wake up at 8:30. I'm going to turn my stream on. I'm going to come into Thinkorswim, and I'm going to be calling out my trades that I'm making and how much we make off of those trades. All right. I'm not saying I'm going to do good on Friday. Maybe I won't perform well under pressure, but we'll see. But I'll walk you guys through my thought process, what I'm doing. I'll chart everything out in the morning and tell you why I'm trying those things out, what I'm seeing, and how I'm making my trades. So make sure you follow the YouTube channel, subscribe. Friday we'll be live. I'll be working on a video. I'll be working on 2 videos this week for you guys. The first video is going to we're going to go from the ABCs of trading, or the ABCs of investing. I'll say how to open up a broker's account, how to get started, and then how to get options, we're going to go through all that on the channel. So just make sure you follow. And yeah, I look forward to growing with you guys and giving you guys all the information that at least I can share with you to get you guys started on your trading journey. Good luck to you all, and I will see you all next time. Take care.